In accounting, a trial balance is prepared to check whether the total of debit balances agrees with the total of credit balances. If both totals match, the trial balance is said to be tallied. However, the agreement of a trial balance does not guarantee the absence of errors in accounting records. Certain types of errors do not affect the equality of debit and credit totals because the double entry principle is still followed, even though the transaction is wrongly recorded. Such errors are not disclosed by the trial balance and can materially affect profits, assets, and liabilities. Limitations of trial balance in detecting errors. A trial balance is prepared primarily to check arithmetical accuracy, not the correctness of accounting treatment. It fails to disclose errors arising from wrong classification of accounts, incorrect application of accounting principles, omission or duplication of transactions, recording of wrong amounts. Therefore, trial balance should be regarded only as a preliminary check, not as conclusive proof of accurate accounts. Errors not disclosed by trial balance. Error of omission. Meaning and nature. An error of omission occurs when a business transaction is completely left out from the books of accounts. In such cases, neither debit nor credit entry is passed in any account. Illustration. Goods purchased on credit from a supplier for 40,000 rupees are not recorded in the purchase book or ledger. Accounting impact. Since no entry is made in any account, both debit and credit are missing. Effect on trial balance. The trial balance continues to tally because the double entry system has not been partially violated, it has not been applied at all. Practical implication. This error leads to understatement of expenses, liabilities, or income affecting profit calculation. Error of commission. Meaning and nature. An error of commission occurs when the correct amount of a transaction is recorded but is posted to the wrong account, usually within the same category or class of accounts. Illustration. 10,000 rupees received from customer A is wrongly credited to customer B's account. Accounting impact. Cash account is correctly debited and a debtor account is credited, but the identity of the debtor is wrong. Effect on trial balance. Since one debtor account is wrongly credited instead of another, total debits and credits remain equal. Practical implication. Individual customer balances become inaccurate, leading to incorrect receivable management. Compensating errors. Meaning and nature. Compensating errors arise when two or more independent errors cancel each other's financial effect, resulting in no net difference in debit and credit totals. Illustration. Sales account is undercast by 6,000 rupee while purchases account is also undercast by 6,000 rupees. Accounting impact. Both revenue and expense figures are understated by the same amount. Effect on trial balance. Since the understatements offset each other, the trial balance still agrees. Practical implication. Such errors can seriously distort financial ratios and trend analysis. Error of principle. Meaning and nature. An error of principle occurs when a transaction is recorded in violation of fundamental accounting principles, particularly in distinguishing between capital and revenue expenditure or income. Illustration. Expenditure incurred on acquiring machinery is debited to the purchases account instead of machinery account. Accounting impact. The expense is treated as revenue instead of capital, affecting both profit and asset valuation. Effect on trial balance. Both debit and credit entries are correctly made, so trial balance remains unaffected. Practical implication. This error leads to incorrect profit determination and misrepresentation of financial position. Error of duplicate entry. Meaning and nature. An error of duplicate entry occurs when a transaction is recorded more than once in the books of accounts. Illustration. A purchase of goods worth 12,000 rupees is entered twice in the purchases book and posted twice to ledger. Accounting impact. Both purchases and creditors are overstated. Effect on trial balance. Since both debit and credit are duplicated, the trial balance continues to tally. Practical implication. Overstatement of expenses or assets results in distorted financial statements. Complete reversal entry. Meaning and nature. A complete reversal entry occurs when the correct accounts are used, but the debit and credit sides are completely interchanged. Illustration. Cash received from a customer is credited to cash account and debited to the customer's account. Accounting impact. The effect of the transaction is completely reversed. Effect on trial balance. Since debit and credit amounts are equal, trial balance agrees. Practical implication. Balances of accounts are reversed, causing serious misstatements. Error of original entry. Meaning and nature. An error of original entry arises when a transaction is recorded in the book of original entry with an incorrect amount and the same wrong amount is posted to both debit and credit accounts. Illustration. Goods purchased for 25,000 rupees are recorded as 2,500 rupees and posted accordingly. Accounting impact. Both purchase and creditor accounts are understated. Effect on trial balance. Debit and credit totals remain equal. Practical implication. Gross profit and liability figures become inaccurate. Methods of detecting errors not shown by trial balance. To detect such errors, accountants adopt the following techniques. Detailed verification of vouchers and invoices. Comparison of current year accounts with previous periods. Ratio analysis and trend analysis. Scrutiny of unusual or abnormal balances. Reconciliation of subsidiary ledgers. Debtors and creditors reconciliation. Internal audit and management review. Importance for examinations and interviews. This topic tests a candidate's conceptual clarity of accounting principles, practical understanding of errors, ability to explain limitations of trial balance. Frequently asked interview question. Does agreement of trial balance ensure accuracy of accounts? Model answer. No. Agreement of trial balance ensures only arithmetical accuracy. Errors such as error of omission, error of commission, compensating errors, error of principal, error of duplicate entry, complete reversal entry, and error of original entry are not disclosed by trial balance. Conclusion. To conclude, remember this key point: agreement of trial balance does not guarantee error-free accounts. It only confirms arithmetical accuracy. Errors such as omission, commission, compensating errors, error of principal, duplicate entry, complete reversal entry, and error of original entry can still exist even when the trial balance tallies. That's why a true accountant looks beyond the trial balance, applies accounting principles, and verifies figures carefully. If this video helped you, like, share, and subscribe for more practical accounting insights. Thank you for watching.